Friends, thank you for being here today. What if I told you that right now, at this very moment, millions of Canadians are staring at their January paychecks, wondering if they've been demoted? What if the invisible force that just sliced hundreds of dollars from your net pay isn't a mistake, isn't a glitch, and isn't even hidden? It's a mathematical reality that landed on January 1st, 2026, and it's already begun reshaping how much money you actually take home. We're talking about a system that just increased its claim on your labor by nearly 10% for high earners, and most people won't understand what hit them until they check their pay stub. This isn't speculation, this is observable. As of today, January 8th, 2026, the fully phased in second earnings ceiling, what they're calling CPP2, is now extracting additional taxes from anyone earning over $71,000. And here's the part nobody expects: you're not just paying more, you're paying longer. The tax free break that used to arrive in November or December has been legislated out of existence. Let me be precise. The maximum annual contribution just jumped to $4,746.45 per person. If you're self-employed, that number doubles to a crushing $9,292.90. That's not a typo. That's the new architecture, and this part has already begun. This is a structural fault line, not a policy adjustment. It's a mathematical endgame hiding behind the language of pension enhancement, and the consequences are vanishing in real time. Because what I'm about to show you is how this January paycheck shock connects directly to a bailout most Canadians don't even know is happening. We don't have months to figure this out. The deduction is already on your pay stub. So let's go back to the beginning, because this story doesn't start in 2026. It starts with a promise made decades ago, a promise that was always designed to be broken. The Canada Pension Plan was established in 1965 as a mandatory savings system. The original pitch was elegant. You contribute a small percentage of your income, your employer matches it, and when you retire, you receive a predictable monthly benefit. It was sold as social insurance, a safety net for workers who didn't have corporate pensions. And for decades, it functioned reasonably well within its original parameters. But here's the detail even analysts tend to miss. The CPP was never designed to be your primary retirement income. It was designed to replace roughly 25% of your pre-retirement earnings, capped at a modest income threshold. For most of its history, that threshold, the year's maximum pensionable earnings, moved slowly, adjusted only for inflation. The tax rate stayed relatively stable at around 4.95% combined. Then something changed. In 2016, the government announced the CPP enhancement, a multi-year plan to increase both the replacement rate and the income ceiling. The stated goal was noble: boost future retirement benefits for a generation of Canadians who were undersaving. The mechanism? Gradually increase contribution rates and create a second earnings ceiling, a higher tier where additional taxes would apply. This is where the scaffolding starts to crack. Because the enhancement wasn't funded by cutting government spending or reallocating existing budgets, it was funded by increasing the tax burden on current workers. You became the exit liquidity for a system that needed more cash flow to meet its obligations. Let me show you what actually happened. The base contribution rate climbed from 4.95% in 2018 to 5.95% by 2023. That's a 20% increase in the tax rate in just 5 years. But that's not the real problem. In 2024, they introduced the second ceiling, CPP2, which added an additional 4% tax on earnings above the base threshold. This wasn't a pension enhancement. This was a surtax dressed up as retirement planning. And this is where the first domino falls, because on January 1st, 2026, the CPP2 system reached full phase-in. The base threshold, the YMPE, jumped to $74,600. The new upper threshold, the YAMP, landed at $85,000. Anyone earning in that $2,400 spread is now paying an extra 4% on top of the base 5.95%. This is the moment the clock actually starts. Here's what that looks like on the ground. Imagine you're a mid-level manager earning $80,000 a year. In 2025, you paid CPP contributions until you hit the old ceiling, and then those deductions stopped, usually around October or November. Your last two paychecks of the year felt lighter, more breathing room for holiday expenses or January bills. That relief is gone. In 2026, you're paying the base rate on the first $74,600, and then you're paying the additional 4% rate on the next $400 of your income. The deductions don't stop until you've been taxed on the full $85,000. But once this shifts, everything above it starts to shake because the government didn't just raise the ceiling, they changed the calendar. For high earners, CPP deductions used to max out in the fall, giving you a few months of slightly higher take-home pay. Now, those deductions stretch through the entire year. The psychological impact is profound. You feel poorer even if your gross salary stayed the same. And here's where everything changes. Your first paycheck of 2026 is significantly lighter than your last paycheck of 2025, not because you got demoted, but because the CPP deductions restarted on January 1st. For someone earning $80,000, that first paycheck might be $200 to $250 lighter than the final check of December. Any raise you received, 2%, 3%, even 5%, was likely swallowed whole by the restart of these statutory deductions. Let's cut through the noise. The government is calling this a pension enhancement. They're telling you that you'll receive higher benefits when you retire in 40 years. But this part isn't a prediction, it's math. If you're 35 years old today, you're paying cash right now for a promise that won't materialize until 2065. You're funding a system you might never fully capitalize on because the demographic mathematics don't work. Here's the part they never put in the official reports. The Canada Pension Plan Investment Board, the entity that manages your contributions, oversees a portfolio worth hundreds of billions. In recent years, they've made aggressive bets on commercial real estate, private credit, and infrastructure assets. And while their equity holdings performed well in 2024 and early 2025, their real estate portfolio faced significant headwinds. Office vacancy rates in Toronto and Vancouver spiked. The value of those trophy towers they bought in 2018 and 2019, when interest rates were near zero, has been quietly written down. This is the mechanism hiding in plain sight. Why does the government need more tax revenue for pensions right now? Is it to fund future benefits, or is it to backfill the losses from assets that no one else wants to buy? When you increase mandatory contributions by 20% over 5 years, you create a steady stream of fresh capital. That capital can be deployed into illiquid markets, buying distressed assets at inflated prices, providing exit liquidity for institutional investors who got in early and want out now. Let me be precise. The CPP enhancement isn't about securing your retirement. It's about securing the solvency of a portfolio that made bad bets during the zero interest rate era. You are the bailout. Your paycheck is the rescue package. And the best part, you don't get to vote on it. You don't get to opt out. It's a mandatory extraction, a statutory deduction that shows up on your pay stub whether you like it or not. And this is where the cascade becomes unstoppable, because CPP isn't just a tax on you, it's a tax on your employer. Every dollar you contribute, your boss matches. When the government increases your CPP burden by $400 a year, they're also increasing your employer's cost by $400. That's $800 per employee in additional payroll taxes. Here's the moment small businesses get crushed. Your boss can't afford to give you a 5% raise because the cost of employing you just went up by nearly 10% when you factor in CPP, EI, and other statutory increases. The wage growth you were expecting? It's not coming. The government took it before your employer even had a chance to offer it. This part is non negotiable. Payroll taxes suppress wage growth. They discourage hiring. They push businesses toward automation, outsourcing, or simply freezing headcount. For the average household, this means your gross income might tick up by 2% or 3%, but your net pay stagnates or even declines. You're running faster just to stay in place. We haven't even reached the breaking point yet because the CPP2 system is designed to escalate. The thresholds, the YMPE and YAMP, are indexed to wage growth. As average incomes rise, the ceilings rise, and more of your income gets pulled into the taxable base. This isn't a one-time shock. This is a permanent recalibration of how much the government claims from your labor, but that's not the real problem. The real problem is what happens when you combine this payroll tax escalation with the other forces converging on Canadian households right now. Because we're not just dealing with higher CPP contributions. We're dealing with a trifecta of financial pressure that's hitting simultaneously, and the timing is catastrophic. Let me show you what actually happened in the last 6 months. While everyone was focused on interest rates and inflation, three separate mechanisms were quietly tightening around the average Canadian worker. First, the CPP2 full phase-in we just discussed. Second, employment insurance premiums increased again for 2026, adding another $50 to $100 annually to your deductions. Third, provincial tax brackets in most provinces failed to keep pace with inflation, meaning bracket creep is pulling more of your income into higher tax rates, even if your purchasing power didn't actually increase. This is where common sense actually becomes your enemy. You look at your gross salary and think, I'm making more than I did 2 years ago. But when you look at your net pay, when you look at what actually hits your bank account after all the statutory deductions, you realize you're treading water. The money illusion is complete. You became wealthier on paper, but poorer at the grocery store. And here is where the crack that becomes an earthquake. Because the CPP2 shock isn't happening in a vacuum. It's happening during a period of unprecedented household debt. The average Canadian household is carrying mortgage debt at levels never seen before, over $300,000 in many urban markets. Credit card balances are at record highs. Auto loans are stretched over 7 and 8 years. And now, just as households need every dollar of cash flow to service these debts, the government is extracting an additional $400, $800, even $200 from annual take-home pay. Here's what that looks like on the ground. Imagine you're a dual-income household in the Greater Toronto Area. You and your partner both earn $85,000. Combined, you're now paying close to $9,300 in CPP contributions annually, not including your employer's matching contributions. That's $775 per month in statutory pension deductions alone. Add in EI, add in federal and provincial income taxes, and your combined net pay might be 35% to 40% lower than your gross pay. Now factor in your mortgage payment, let's say $3,200 a month on a $650,000 home, add property taxes, $400 a month, utilities, insurance, groceries at inflated prices, daycare for 2 kids at $2,000 a month. Before you've paid for transportation, clothing, or any discretionary spending, you've burned through nearly your entire net income. And this part has already begun. The data forces one conclusion. Canadian households are being compressed between rising mandatory deductions and rising cost of living. The margin for error is vanishing. The buffer that used to exist, the extra $500 or $800 a month that lets you save for emergencies or invest for the future, that buffer is evaporating in real time. But here's the part the experts gloss over. This compression isn't accidental. It's the predictable outcome of a system that prioritized asset price inflation over wage growth for the past 15 years. When central banks held interest rates at emergency levels for a decade, they inflated real estate prices, they inflated equity markets, they inflated the value of financial assets held by the top 20% of earners. But they didn't inflate wages, they didn't inflate your paycheck. So now, when the government needs more revenue to fund pensions or healthcare or infrastructure, where do they go? They can't tax wealth effectively because that would crater asset prices. They can't raise corporate taxes significantly because that would drive capital offshore. So they do the only thing left. They raise payroll taxes. They tax labor. They tax you. This is not a conspiracy. It is a stated policy. It's written into the CPP enhancement legislation. It's embedded in every federal budget. The government is explicitly shifting the tax burden from capital to labor, from wealth to wages, from assets to paychecks. And the genius of the system is that most people don't even notice until January when they check their pay stub and wonder why they feel poorer despite getting a raise. Let me be precise about the timeline. The CPP enhancement began in 2019. By 2025, contribution rates had climbed significantly, but 2026 is the year the system reaches its mature state. This is the year when the second ceiling is fully operational, when the additional 4% surtax applies to the full $10,400 spread between the base and upper thresholds. This is the year when the architecture is complete. And this is where everything changes, because once the system is fully phased in, the only direction it can go is up. The thresholds will increase every year with wage inflation. The rates are locked in by legislation. There's no mechanism for reduction, no political will to reverse course. You're locked into a system that will extract a larger share of your income every single year for the rest of your working life. Human beings are hardwired to believe tomorrow will look like yesterday. We assume that the paycheck we received last month is roughly the same as the paycheck we'll receive next month. But that assumption is breaking down. January 2026 is the month when millions of Canadians will experience a sharp, immediate drop in net pay, and many won't understand why. They'll assume their employer made a mistake. They'll call HR, they'll check their direct deposit, and then they'll see the line item CPP2. This is not theoretical, it's observable. The deductions are already appearing on pay stubs across the country. The social media posts are already starting. People are asking, why did my paycheck just drop by $200? The confusion is real. The anger is building. And here's the part that scares me. Most people still don't connect the dots. They don't realize this is permanent. They don't realize this is the new baseline. Let me show you the forensic evidence. In late 2025, before the CPP2 full phase-in, a worker earning $80,000 might have had net monthly pay of around $4,800 after all deductions. In January 2026, that same worker with the same gross salary might see net monthly pay drop to $4,600 or $4,550. That's a $200 to $250 monthly reduction. Annualized, that's $2,400 to $3,000 in lost purchasing power, not because of inflation, not because of a recession, because of a statutory deduction increase that most people didn't even know was coming. And here is where the domino sequence accelerates. When millions of households lose $200 to $300 in monthly cash flow, they don't just absorb it silently. They adjust their behavior. They cut discretionary spending. They delay purchases. They stop going out to restaurants. They cancel subscriptions. They skip vacations. Consumer spending, which represents roughly 60% of Canadian GDP, starts to soften. But once this shifts, everything above it starts to shake because the businesses that rely on consumer spending, the retailers, the hospitality sector, the entertainment industry, they start to see weaker sales. They delay hiring, they freeze wages, they lay off marginal workers. The economy begins to slow, not because of a recession in the traditional sense, but because of a structural reduction in household cash flow engineered by government policy. This was inevitable the moment they legislated the CPP enhancement. You cannot extract an additional $10 billion to $15 billion annually from household paychecks without consequence. That's $10 billion to $15 billion that won't be spent at small businesses, that won't be saved in TFSAs, that won't be invested in RRSPs. It's been redirected into a pension system that, as we discussed earlier, is using that capital to backfill losses on commercial real estate and other illiquid assets. Here's the mechanism hiding in plain sight. The CPP Investment Board doesn't just sit on your contributions. They deploy them aggressively into global markets. They buy stakes in toll roads, airports, power grids. They invest in private equity, venture capital, distressed debt. And while some of these investments perform well, others don't. When the office tower market collapsed, when remote work decimated demand for commercial space, the CPPIB was left holding billions in assets that declined sharply in value. So what do? They need fresh capital to stabilize the portfolio, to meet their actuarial obligations, to maintain the illusion of solvency. And the easiest way to get fresh capital is to increase mandatory contributions. Force every working Canadian to contribute more. Use that inflow to buy assets at depressed prices, hoping for a recovery. And if the recovery doesn't come, increase contributions again in 5 years. This is a default in all but name. The CPP isn't failing in the traditional sense. It's not going bankrupt, but it's requiring ever larger infusions of capital to maintain its target returns. And the source of that capital is you, your paycheck, your labor, your future. We don't have months to figure this out. This is happening in days because the January paycheck shock is just the beginning. Over the next 12 months, as Canadians realize their net pay has been permanently reduced, the psychological impact will compound. People will start questioning the value proposition. They'll ask, why am I paying $4,600 a year into a pension I won't access for 40 years? They'll ask, why can't I opt out and invest this money myself? And here's where the system reveals its true nature. You can't opt out. CPP is mandatory. It doesn't matter if you have a corporate pension. It doesn't matter if you're maxing out your RRSP and TFSA. It doesn't matter if you're a disciplined saver who doesn't need government-managed retirement funds. You pay, period. This is where the convergence becomes undeniable. We're facing three simultaneous forces. Force one, inflationary adjustment of the base threshold means you pay more even if your salary stays flat. Force two, the CPP2 phase-in means high earners pay significantly more through the new surtax. Force three, the January reset means everyone experiences an immediate cash flow shock right when holiday debt and January bills are due. The prediction is mathematical. 2026 will be the year of net pay stagnation. Gross wages might rise by 2% or 3% due to collective bargaining agreements or cost of living adjustments. But net pay, the money that actually hits your bank account, will flatline or decline for millions of Canadians. The illusion of wage growth will be exposed as just that, an illusion. But that's not even the part that should concern you most. What should concern you most is that this system was designed to be invisible. It was designed to extract wealth slowly enough that you wouldn't revolt, consistently enough that you'd accept it as normal, and automatically enough that you'd never have a choice. This is the big secret of the entire system. Statutory deductions are the perfect tax because they disappear before you ever see the money. Think about how this works psychologically. When the government raises income taxes by 1 percentage point, you notice, you feel it, you complain. Politicians face backlash. But when they increase CPP contributions by 20% over 5 years, most people don't even register the change. It happens incrementally. It's buried in a line item on your pay stub between federal tax and employment insurance. It's technical, it's boring, it's invisible, and this is the detail even analysts tend to miss. The CPP enhancement legislation was passed in 2016, nearly a decade ago. The phase-in was deliberately stretched over 7 years so that no single year felt catastrophic. A 0.15% increase here, a 0.30% increase there, a gradual lifting of the earnings ceiling. Each individual change was small enough to avoid triggering mass awareness, but when you add them all together, when you reach the end point in 2026, you realize the system just confiscated an additional 20% to 25% of your marginal earnings. For someone earning $85,000, the total CPP bite in 2026 is $4,646 or 45 bars. In 2018, before the enhancement began, it was around $2,594. That's an increase of over $2,000 annually, or roughly $170 per month. For a dual income household, double those numbers. That's $4,000 a year, or $340 per month, that vanished from household cash flow over the course of this phase in. Here's what that means in real terms. That's a car payment, that's a mortgage payment on $80,000 of debt. That's groceries for a family of 4 for 6 weeks. That's the RESP contribution you were planning to make for your kids' education. That money didn't disappear into the ether. It was systematically redirected into a pension system that will, if everything goes according to plan, return it to you in 40 years with modest adjustments for inflation. But here's the part nobody expects. The math only works if the system continues to exist in its current form for the next 4 decades. It only works if there's no major restructuring, no default, no political decision to means test benefits or raise the retirement age again. It only works if the CPPIB achieves its target returns of 4% to 5% above inflation every single year. And it only works if Canada's demographics don't deteriorate further, if the worker to retiree ratio doesn't collapse, if immigration maintains current levels. Those are a lot of assumptions, and every single one of them is vulnerable to disruption. This is where the certainty frame breaks down. I can tell you with confidence what's happening right now. Your paycheck is lighter, your net pay is stagnating, and the government is extracting more from your labor. But I cannot tell you with confidence that the pension promise will be honored in full when you retire in 2060 or 2065. This is the money illusion at its most perverse. You're sacrificing purchasing power today for a promise tomorrow, but the promise is denominated in future dollars that may be worth significantly less due to inflation, or that may be reduced due to policy changes you have no control over. You're trading certainty for uncertainty, cash for commitments, present for future. And this is where the crack becomes an earthquake. Because once Canadians start doing this math, once they realize they're paying $4,600 a year for a benefit they might not fully collect, the social contract begins to fracture, trust erodes, resentment builds, and the government's ability to raise taxes further to extract more from labor reaches its political limit. We're not there yet, but we're closer than most people realize because the CPP2 shock is hitting right as household finances are already stretched to the breaking point. This is not a theoretical crisis that might happen in 5 years. This is a cash flow crisis happening right now in January 2026 in real time. Let me show you the canary in the coal mine. Over the past 3 months, credit card delinquency rates in Canada have started ticking up. Not dramatically, but noticeably. Auto loan defaults are rising. Mortgage arrears, while still low, are no longer declining. These are early warning signals. These are the forensic traces of households that have run out of slack, that have exhausted their buffers, that are one unexpected expense away from financial distress. And here's where the domino sequence becomes unstoppable. When a household misses a credit card payment, their interest rate spikes. When they miss an auto loan payment, their credit score drops. When they're forced to tap their home equity line of credit to cover January bills, they're pulling forward future consumption to pay for present obligations. They're borrowing from tomorrow to survive today. This is the moment the tide goes out and we find out who's been swimming naked. Because the Canadian economy has been running on household credit for years. Consumption growth was financed by rising home equity and cheap debt. But now, with interest rates higher, with home prices stagnant or declining in many markets, with net pay stagnating due to CPP and other statutory deductions, that engine is sputtering. For the average household, this means the margin for error is gone. You can't absorb another $200 monthly hit to your cash flow without consequence. You can't weather a job loss or a medical emergency or a major car repair without going into debt. You're operating at the edge of your capacity, and the CPP2 shock just pushed you closer to that edge. Here's the part they never put in the official reports. When the government projects CPP sustainability, they use optimistic assumptions about wage growth, employment rates, and investment returns. They assume the economy will continue growing at 2% to 3% annually. They assume inflation will stay tame at 2%. They assume no major financial crisis, no pandemic, no geopolitical shock that disrupts global trade. But the simple logic does not apply here. We live in a world of compounding fragility. The assumptions that held for the past 30 years, the assumptions of relative stability and predictable growth, are breaking down. We've seen a pandemic that shut down the global economy. We've seen inflation spike to levels not seen in 40 years. We've seen interest rates rise from near zero to 5% in less than 18 months. The models are failing because the world is no longer behaving according to the models. And this is where everything changes, because if the CPPIB's investment returns underperform, if they only achieve 3% real returns instead of 4.5%, the system's actuarial balance deteriorates. The government will face a choice: raise contribution rates again, cut future benefits, or inject taxpayer money to cover the shortfall. All three options are politically toxic. All three options represent a broken promise. This was inevitable the moment they designed a pay-as-you-go system with defined benefits. You're not saving your own money in your own account. You're funding current retirees' benefits with the promise that future workers will fund yours. It's an intergenerational transfer disguised as a pension plan, and it only works if each generation is larger and wealthier than the one before. But Canada's birth rate is below replacement level. Immigration is offsetting some of the demographic decline, but not all of it. The worker to retiree ratio is declining. By the time millennials and Gen Z retire, there may not be enough workers to fund the benefits that were promised. The math doesn't work. The system is structurally unsound. This part isn't a prediction, it's math. You can look at the birth rates. You can look at the actuarial reports. You can project the trajectories. And when you do, you reach one undeniable conclusion. The CPP, as currently structured, cannot deliver on its promises without either raising taxes dramatically or cutting benefits significantly. So here's the convergence. You're paying more right now. Your net pay is stagnating. Your household cash flow is compressed. And the system you're paying into is structurally fragile, vulnerable to demographic decline, investment underperformance, and political interference. You're sacrificing present consumption for a future benefit that may not materialize in full. This is the binary choice you face. Do you accept this as inevitable? Do you assume the government will figure it out? Do you hope that somehow, despite all the structural headwinds, the CPP will deliver on its promises? Or do you take control of what you can control? Because here's what I know, you cannot opt out of CPP. It's mandatory. The deductions will continue whether you like it or not. But you can opt in to your own retirement planning. You can max out your TFSA. You can contribute to your RRSP. You can build a portfolio of assets that you control, that you own directly, that aren't subject to government policy changes or actuarial assumptions. This is not financial advice. This is a statement of structural reality. The CPP is a government-managed, politically influenced, demographically challenged pension system that is extracting more from you every year while promising benefits 4 decades in the future. Your TFSA is a tax-sheltered account that you control, that you can access before retirement if needed, that isn't subject to future benefit cuts. The choice is binary. You can treat CPP as your primary retirement plan and hope the system survives intact for the next 40 years. Or you can treat CPP as a mandatory tax that might give you a modest rebate in retirement and build your real retirement security through assets you control. For pensions, this is catastrophic because once people lose faith in the CPP, once they realize they're funding a system that might not deliver, the political pressure to allow opt-outs or privatization will intensify. And if that happens, if even 10% or 20% of high earners are allowed to opt out, the system collapses because it relies on everyone paying in. It relies on high earners subsidizing low earners. It relies on young workers funding retirees. This is the death spiral of a pay-as-you-go system. Once trust erodes, once contributions become politically controversial, once people demand the right to control their own retirement savings, the entire architecture becomes unstable. We're not there yet, but the CPP2 shock is accelerating us toward that point. And this is where the countdown quietly began. January 2026 is the month when millions of Canadians will question the value proposition. They'll see the deduction on their pay stub. They'll calculate the annual cost. They'll divide by 40 years, and they'll realize they're paying $4,600 today for a benefit worth maybe $1,500 annually in retirement. The return on investment is terrible. The opportunity cost is massive. History favors the prepared, and the window for preparation is closing. You cannot change the CPP system. You cannot opt out, but you can prepare for a future where government promises are worth less than you hoped. You can build your own assets. You can own things that hold value regardless of political decisions or demographic trends. This is not about doom. This is about clarity. The CPP2 shock is real. It's hitting your paycheck right now. It's extracting more from your labor. And the system it's funding is structurally fragile. Those are facts. What you do with those facts is your choice. Friends, check your pay stub. Look at the CPP line item. Calculate what you're paying annually. Then ask yourself, is the government's promise worth more than your own disciplined saving? Because that's the real question. That's the choice you're being forced to make, whether you realize it or not. The liquidity tide is going out, and we're about to find out who built their retirement on solid ground and who built it on government promises. The math is unforgiving, the timeline is accelerating, and the window for action is narrowing. This is the moment you decide whether you're a passenger in the system or the architect of your own financial future, because the system just told you exactly what it thinks you're worth. $4,600 a year in forced contributions for a promise it might not keep. History favors the prepared, and preparation starts with seeing the system clearly, without illusion, without hope, without assuming tomorrow will look like yesterday. Thank you for being here, friends. The truth is hard, but it's better than the alternative.